thoughts and opinions expressed on Halal Money Matters do not necessarily reflect the views of Saturna Capital, Amana Mutual Funds, or their affiliates. Welcome to Halal Money Matters, presented by Saturna Capital. I'm Christopher Patton.
And I'm Oneem Salam.
Today's episode is really seeking to answer a question, and I want to know your take on this question before we jump in with our guest, and that is, does the Islamic model of investing outperform what we would call traditional finance?
Yeah, so we get this question a lot, and whenever we're out, typically, people aren't really, industry practitioners are not asking a question, they're making a statement.
So there's a strong belief then.
There's
already.
A strong belief
okay.
that's out there. And so, it's like, okay, let's dig into this a little further. Is there really something there is really the idea. And so, from a retail investor perspective, they're happy and they're proud of the fact that they would be, outperforming. But it's for them, it's like, are we, as long as we're not underperforming, it's like really badly, then they should be fine with the Islamic principles. But I really like this episode because it kind of drills down into, okay, let's talk about this outperformance and what does that really mean?
And perhaps not surprisingly, this might be a harder question to answer. It may not be just a yes or no answer, shockingly.
Yeah.
To help us dig into this question, we're going to speak with Dr. Dawood Ashraf. He's a senior research economist at the Islamic Research and Training Institute. He's got a PhD in banking and finance from the University of Wales.
Yeah, and he's really kind of, spent most of his professional life researching this exact topics that we're going to be talking about today. So I'm really excited. So thank you, Dr. Ashraf, for joining us on this topic. Does Islamic investing really outperform? I think this is a question that comes up over and over again. And, as Muslims, we're very, very proud of the fact that the answer for us, at least, is always yes. And so I think this is a good topic for us to discuss. And really, from your research, which, alhamdulillah, you've been able to do quite a bit of in this area, maybe we'll be able to come up with an answer which is more succinct and maybe even truthful. What do you think, Chris?
Yeah, I'm curious. Is the answer yes? We're settled on that? Sounds like we've answered the question already.
The answer is yes and no as well. It depends on the time period that you're looking at. Given my background, when I started first, so I had that feeling that the Sharia screening helps investors to gain better returns for two major reasons. One is the absence of sin stock from the portfolio, and second is the lower leverage. So having lower leverage means that when the market is going really, really down and financial stocks are beating up quite a bit, so at that point in time, your portfolio will act like a hedge against this whole situation. And with that view in my mind, I started my research on Islamic equity investings. And the initial results, I took the first one on the Saudi market, as Saudi market was the biggest market. Saudi still is the biggest market for the mutual fund investing. So I looked at it and I find that there are mutual funds that are performing better than their benchmark, and but there are other ones that are not performing better than their benchmark, which simply tells me that there are some good managers and there are some bad managers.
It makes more sense, I guess, to do it like a regular index to a Sharia index rather than an index to a manager, right? Because you're right, it does play into how good the manager is, or he's just on a good run and maybe he won't perform 3-4 years later.
Exactly. See what happens. So that's what my thought was immediately once I finished that paper, finished that research. I had the feeling that it may be the manager. It's not the Sharia screening standard or anything. So the second piece that I worked on was basically looking at this specific question. And then at that point in time, I thought maybe like, if I pick up mutual funds and try to understand the performance difference, I may not be able to get the right answer. So I worked with a colleague from Prince Muhammad University, and we looked into the performance of indices. And then at that point in time, the ideas were more clear. Is it the performance all time, or is it the performance during the downturn of the market, and so on and so forth. So this piece of research, what we did is we used indices. So this is now what we're trying to compare Apple with Apple. So the benchmark is an index, and the Sharia compliant in equity investment is an index as well. So we took out the manager, we took out the market timing. And then, as I mentioned to you, the idea was to look at whether this performance is in general every time we get it, or is it specific to a specific time period. So in that piece of research, what we found was that there is no evidence that the Islamic equity investment outperforms the conventional investments at all the time. However, we find that at times, and especially during the time when the market is experiencing an extreme downfall. So it's not the downfall that we see, say, for example, after every 3, 4, 5 weeks, we see the market is going down a few hundred points and then it recovers back. I'm talking about that the market went down maybe around 20 to 25, more than 10%. And then in those times, we see that the performance of the Islamic equity investments are better than the conventional investments. So we look at the basic model of using the capital asset pricing to understand what are the source of that performance deviation, if there is any. We consistently have observed that the downfall of the Sharia compliant investment vehicles are far less than the downfall of the general market. But it was significant, like in terms of being a researcher, so it was statistically significant. So these are the things that are important. So, but when we talk about the equity investment, there are several other things that we need to look at. And I must say that the performance difference could come from within the Sharia screening criterions. So say, for example, the major Sharia screening criteria that has come from this contemporary Sharia scholars is the Dow Jones Sharia screening criteria back in 1998, 99. This criteria used the quantitative screening by using the market value of equity. While there are other screening criteria that use book value of equity as the basis for determining the leverage and all other ratios for compliance status. So if we look at these different standards, then maybe there is a difference between the performance based on the Sharia screening standard. And what we found time and again is, first, let me put this how it is different. So when you're using the market value of equity as the denominator for the Sharia screening, so what happened is when the market is going up more quickly, those equities that are gaining value, that they're gaining in price, will become Sharia compliant. And when the market is going down, those equities that are losing values quickly will be Sharia incompliant sooner. So this way, the market mechanism can help. On one side, it could exacerbate. On the other side, it can be helpful in terms that it will help the manager, fund manager, to quickly make the decision and get out of the position. But at the same time, the manager is working with the portfolio, which is kind of following a momentum strategy.
Yeah, and that's a really good point that you mentioned, because conventional wisdom, or at least in the Islamic investment community, is that during a bull market, when the markets are going up, the highly leveraged companies actually tend to outperform because they have the leverage. And then in the down market, the reason why Islamic investing outperforms is because those are the companies we never owned, and thus those are the ones that are falling the worst because they have debt and they can't pay their debts, that type of thing. So are you saying that might not be the case, and it's more about the fact of this momentum shifts that happen?
See, the thing is, like, how an equity would be Sharia compliant is based on the denominator.
So just for our listeners, majority of the Sharia screens have a debt, total debt, to either market capitalization, which is the denominator, or total assets, which is the denominator. And most of them have it between less than 30 or 32%. So basically, exactly. Go ahead. I just wanted to clarify.
So what happened with this one is, so say, for example, if an equity is Sharia incompliant because of the debt leverage ratio. as the price of that equity start rising and it gets to the threshold level where it comes under 33%. So now in that case, if the price goes up, so the Sharia compliant equity holder will benefit, if it buys it at the 33% point, will get benefit from the rise in price. So he will get the whole benefit of rise in price as soon as the equity touches the threshold point. Now, on the other side, as soon as the price of that equity started going down, so it will become quickly Sharia incompliant as it breaks the ceiling of 33% or 30%, whatever be the number that the Sharia, the fund manager is following. Mm-hmm. And then suddenly this equity will become incompliant and it has to go out of the portfolio. So this means that on both sides, on the upside, the fund manager can benefit from the rising price. And on the downside, it can protect itself as soon as it touches the floor. So given this situation, but personally, I believe that it will be beneficial to the equity holder. But my concern most probably is on the Sharia compliance side, that are we getting into a speculative portfolio which basically follow the trend in the market. So that needs to be addressed. And that is one of the concern when we are using the market value of equity. But on the other side, when we are using the book value of equity, the adjustment in the market is too slow. Most of the time, it is after almost 1 year. So 1 year time, the fund manager can hold on. But during this time, whatever has happened to the stock in the market, the stock will remain in the portfolio. So again, one or the other way, there are issues that can raise in one or the other standards. So the next piece of my research that I looked at was whether there is a difference in performance based on the Sharia screening standard. So this happened in 2016, and I had the data until 2014. So given that period of time, we did find that the book value of equity being more stable approach for the Sharia screening was kind of more favorable to the Sharia stock, the Sharia compliant equity investors. However, when we did the same analysis in 2021 on the during the COVID and after COVID-19 time, like during this time when there was an extreme shortfall in March to 2020 and then thereafter the recovery. And what we found that the market value of equity in fact helped the Sharia compliant investors to gain better returns than the book value of equity investors in the book value of equity.
So that's more like a more short term in nature, right? I mean, 2 years from 14 to yes. 16 and then now. But we always are, talking to our shareholders about long-term investing, 5-year, 10-year, 15-year. Mostly when they do invest, they're trying to build wealth, right? Not yep. make money. So what happens in that situation?
See, in that, like the first piece of research, as I mentioned, 2014, it was over the 2008, 2000, about 6 years. The horizon. But this one that I'm talking now about, this COVID period, is only 2 years. So, and that is something I believe that there is a need, maybe standardization. Like as you started talking, you try to explain how these two different standards work.
Yeah.
So for any ordinary investor, it is always difficult to get, okay, so which one is better and why you have several standards. So I think it may be a responsibility of the scholars community as well as from the investment side that we should try to reach to a point that is kind of uniform and try to get to a point which is more acceptable to everybody. And then it would be very helpful for the investor as it will reduce confusion. What Sharia standard is a good one or which standard is not as good as the other one.
And that purely has to be done based on Sharia, not based on which one outperforms one or the other. Right now,
for sure not. For sure not.
Yeah.
That's why, like when I say that we need to think very clearly, it is important for the transparency of for the investors as well. Like an investor who's coming with the faith in mind does not have to make decisions which way to go. It has to be transparent, straightforward, and should not be if and what kind of scenarios.
I think that the scholars at least have done a good job. It's what I found is that it really, even in finance, there's a disagreement on how do you value a company. whether it's on assets, what's on the market value, enterprise value, those type of things. So, I mean, they're coming at it from a Sharia perspective, but even in finance, there's a difference of opinion as to how you do that, and that shows up in the Sharia criteria as well. Also, so now going back to this area, so has there been any research done? For example, I mean, so the Dow Jones Index came out, roughly around 1997 or so, and that was during the kind of right in the middle of the .com kind of increase, and then there's a crash, and then other things have happened. But have you done any analysis of, let's supposing, the Dow Jones, all world, for example, and the Dow Jones Islamic Index over like that longer period of time, the 25 years or so?
No, I did not do that. That's a good idea. I think I should look at it now.
Yeah. Well, we might have you on another podcast to talk about that one then.
Sure. See, what we have done is recently, and for that we use a little bit trick to construct our own portfolios, is we took from CRISP the data since 1976 to, if I'm not wrong, 2017. And then based on the constituent S&P 500, we created Sharia compliant indices right from the beginning. Our business screening criteria was not very good. Like we just use an ad hoc approach where we took out all the financial institutions. Then we applied just the leverage ratios and all those ratios. What we found, like that's interesting. I think if there is a difference in performance, maybe it would not be as much because of our a bit ad hoc approach for the business screening. We find that the Islamic equity investments, in fact, has performed over the longer period better than the conventional one. But what interesting is that if we use a smart beta strategy, so say, for example, if we are using a low risk investment strategy, which basically low volatility investment strategy, the performance of Islamic equity investments is far better than the performance of market capitalization based S&P 500. So the same number of stocks, the same time period, the only difference is that the weighting that we have applied is not based on the market capitalization, rather it is based on the riskiness of the stocks. So the higher the volatility of the stock, the lower the weight in the portfolio. And then amazingly, the results were amazing. Like if I'm recalling properly, I think over the period of 25 years on annual basis, our return was like 1.5% or 2% higher than the return of the S&P 500. I'm talking about on average annually.
Yeah, that's a pretty good number.
That's pretty good return. That's pretty good number.
Yeah.
So, and that is something that I think that we all need to look at, that market capitalization is not the only approach to construct portfolio. There are other ways, maybe more suitable for the Islamic equity investments, especially the fundamental weighting in technique would be really helpful for the Islamic equity investors, because the company that are really good in doing their business usually are less leveraged, more dividend paying. So this way, the total return for those companies which are having higher fundamental value would be more beneficial to the investor, especially when, as you mentioned earlier, that the investment is long term. So given the long term horizon, it would be good for the Islamic equity investors to look at portfolio which is constructed not purely based on market capitalization, rather other ways to do that. So in finance, we call them the smart betas, but you can call it with some other name as well. Yes.
Yeah. So just as a recap, and then so that, like, for example, then, from that perspective, if you look at low volatility portfolios, there is a statistical difference, and maybe the Islamic ones do outperform. But generally speaking, on an index comparison, over a longer period of time, as you mentioned, there was statistically no difference. But then periods of time in the middle, when there are, let's say, crises or the market corrections, then there is some kind of a opportunity for Islamic investors to outperform in the funds that they have. Is that pretty much a good summary?
Oh, yes. What we need to look at is whenever we talk about the Islamic equity investment, as Munam has mentioned about the low volatility, it's just not the low volatility. We in the portfolio, you took out sin stocks as well. So you are more comfortable investing in those companies, as you are basically not only getting the return, but also you are performing your social duty as well, where you are investing in those stocks that are more useful to the society.
For me, there's two lessons, right? One is that if you can stick to your beliefs and be able to do just as good as the market on an index level, then why not, right? Because you'll feel more comfortable with it. You'll be able to sleep better at night, and maybe also you'll be in a better place in the afterlife as well, right? So that's one aspect of it. But the second part of it, then it speaks to then, another way to put it would be then, the active management is what could drive the portfolio to do better than an index. And so, active management on the Islamic side would probably then, lead to possibly outperformance over just putting it into an index.
Yeah, see, the thing is, like, if you are comparing the performance of an Islamic fund manager, I always say that you cannot compare the performance of an Islamic fund manager with the performance of S&P 500. So it has to be S&P 500 Sharia, so that you are comparing apple with apple. You're not paying your manager for something that you could achieve without hiring a manager. So if you're hiring an active manager, it has to be pure performance and alpha, which is produced by the manager, not by the strategy of investment.
Yeah, that's a good point.
Have you done any similar research into Sukuk and how that compares, and what would you be comparing it to, and that kind of relationship?
Yeah, with the Sukuk, you cannot compare the performance of Sukuk with that of a bond. The reason is both are debt instrument. They don't compete with each other in the sense as the fund managers are competing for funds in case of the Islamic equity investments and the conventional investment. So what you see there is you try to compare the price, whether a company which is issuing a Sukuk, do they have higher cost of funding as compared with issuing a bond? In those cases, it all and then like the issue with the debt issuance is there are so many things within that: the rating of the institution, the rating of the project. It is a bit difficult to compare it in meaningful way. So I never had that opportunity. I tried it a couple of times on index to index level basis. I was not feeling comfortable that the findings that I'm getting is really from the index performance, or is it because of the economic environment in which we are in. So that's why I decided to stay away from that. One good thing that I see in the Sukuk market, especially in the past, let's put it 5 years, and especially the last couple of years, that the sovereigns are more active in the market, especially from the GCC on one side. And second is that the kind of issues that are coming from like green Sukuk, performance-based Sukuk. So all these things are really interesting. And that basically tells us that the Islamic finance industry is growing and is maturing and is able to offer instrument, at least, which is comparable to what the conventional side is offering.
And thank you for the research you have done and will continue to do. I think that goes a long ways for everybody to have a better understanding of it, because the more we know, the better decisions we can make, right?
Sure.
That's kind of the idea.
Yes, it's a good thing that you guys are working on helping investors to understand what they're investing in. And Sharia screening standard and performance of Islamic equity investment is an important area. And I believe that this conversation will help your audience to better understand what are the drivers of performance in Islamic equity investments.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Amana Funds in a current prospectus or summary prospectus, please visit amanafunds.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing. The Amana Funds are distributed by Saturna Brokerage Services, member FINRA and SIPC, and a wholly owned subsidiary of Saturna Capital, the investment advisor to the Amana Funds. Investing involves risk, including the risk that you could lose money. The Amana funds restrict investments to those companies consistent with Islamic and sustainable principles, which limits opportunities and may affect performance. This material is for general information only and is not a research report or commentary on any investment products offered by Saturna Capital. This material should not be construed as an offer to sell or the solicitation of an offer to buy any security in any jurisdiction where such an offer or solicitation would be illegal. We do not provide tax, accounting, or legal advice to our clients, and all investors are advised to consult with their tax, accounting, or legal advisors regarding any potential investment. Investors should not assume that investments in the securities and/or sectors described were or will be profitable. This podcast is prepared based on information Saturna Capital deems reliable. However, Saturna Capital does not warrant the accuracy or completeness of the information. Investors should consult with a financial advisor prior to making an investment decision. The views and information discussed in this commentary are at a specific point in time, are subject to change, and may not reflect the views of the firm as a whole. All material presented in this publication, unless specifically indicated otherwise, is under copyright to Saturna. No part of this publication may be altered in any way, copied, or distributed without the prior express written permission of Saturna Capital.